Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. I'm sure we're all familiar with the name Warren Buffett. We've already featured him a few times in our channel, so you could also give those a watch. Anyways, Warren Buffett is one of the world's best and most successful investors. He's made his money and his name by evaluating individual businesses and purchasing them at a discounted price. His ultimate strategy is about waiting till the right opportunity presents itself. When he sees an opportunity to buy a great company at a low price, he buys massively with the intention of holding the stocks for decades and maybe even centuries if he could. Buffett's technique has led him to invest in companies such as Apple, Coca-Cola, Bank of America, and American Express. All of these companies have performed admirably for him over the years. Actually, the secret to Buffett's success is not in his techniques or strategies, but it's in his temperament.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
Isn't it amazing that the world's best stock picker says that if you don't have the right temperament, you shouldn't even try to do what he does? Having the right temperament and how crucial it is might sound simple, but he is definitely right. Believe me when I say that the main reason investors who pick individual stocks lose money isn't because they don't find great businesses. The problem is that most people who find any great business to buy tend to lose money because they're affected by their emotions when they buy and sell those great businesses at radically different prices at the wrong time. So what do you do when you want to be an investor but can't seem to keep your emotions in check? It's perfectly fine if you recognize yourself in this category, that you won't be able to separate your emotions from your investment. Fortunately for you, during the last few decades, there has been a stock market and an investment strategy that has exploded in popularity. And that is passive investing through ETFs and index funds. It's simply where you buy one stock that represents a wide range of diversification. It represents diversification over the entire market in many cases. So the idea here is that you just show up every year and buy into the market for a long period of time. And what it does is it takes the emotion out of investing because you're not trying to pick the right times to buy in and out. Instead, you're just backing the market in general. The stock market approach is the approach that Buffett recommends for most investors.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
This strategy removes the psychological side of investing and eliminates the need for you to have the right temperament. You don't need to know what stocks to buy. You don't have to worry about what day to get in and get out. You can still produce good results if you give it time. So those are the 2 things you want to possess to be successful in investing. Let me say it again. First, you need the right temperament. Second, you need to allow enough time for the magic to unfold because of course there are times when the market goes up and down. For example, the market did nothing from 1966 to 1978 and received a zero return. But if you wait another 10 years, you'll have a total return of 187% and a compound annual growth of 5%. So it's either 12 years for zero or 22 years for 187% total. So it's a strategy that constantly works if you go on the trip with your dollar cost averaging. And here's Warren Buffett talking about it.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Remember that dollar cost averaging is the way to go because it protects you from two distinct things. First, it protects you from your own emotions. And second, it protects you from what may be market-wide swings. It's drastic market-wide swings because if you stick it out for a long time, you will continue to show up each and every year, slowly but steadily averaging out to that average market return. So work out your plan and you will keep showing up year after year, decade after decade. And that's why Warren Buffett likes this strategy so much and is quick to recommend it even before he recommends his own investing strategy. And he's been saying that for a long time, as seen by this excerpt from his 1996 annual letter to shareholders. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results delivered by the great majority of investment professionals. While it's true that if you take this strategy, you'll likely surpass 70 to 80% of actively managed funds operated by professionals. In the United States, 78% of active funds have failed to beat the S&P 500 during the last 5 years. Over the last 5 years as well, 80% of active funds in Australia have failed to beat the S&P ASX 200. Warren Buffett was so confident that active funds would underperform index funds that he staked $1 million with Protege Partners LLC that a handpicked group of hedge funds would underperform the S&P 500 over a 10-year period. And yeah, Warren Buffett came out on top. Buffett even recommended buying index funds to LeBron James when he asked what he should next invest in.
I think somebody like LeBron, and we've talked about it, but I think...
You and LeBron have talked about it?
Occasionally. I think... Actually, if through the rest of his career and beyond in terms of earning power then, just making monthly investments in a low-cost index fund makes a lot of sense. I think that somebody in his position ought to have a significant cash reserve at whatever makes them comfortable. And then beyond that, owning a piece of America, a diversified piece, bought over time, held for 30 or 40 years, it's bound to do well. And the income will go up over the years, and there's really nothing to worry about.
So there you have it. Warren Buffett, the world's best stock picker, recommends passive investing for most people. No, he doesn't believe it's the best strategy to make money, because he would follow it if it were. But he does believe it's the best strategy to make money for most people, because it eliminates the number one thing that kills active investors' time, and that's their temperament. You don't need the ideal temperament to be a passive investor. All you need to do is commit to a dollar cost averaging plan, then keep showing up. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.